Well, even, characterizing it as a pullback, I mean, we're at 3,950 as we're talking. We've only pulled back from a level that we reached for a day, right? We had a quick move up, but the fact that we're just below 4,000 doesn't really feel like it's a pullback. It's only a pullback in relation to the fact that we almost hit 4,400, which was crazy in that it only took us maybe a week to get there from hitting 4,000. So if you throw that week or two out and just look at where we are, we've gone up a lot on the year. And I think sentiment, it's interesting how such a sharp decline can turn the sentiment to get everybody thinking that this is now potentially a bear market already in gold, and that there's a lot of downside risk. I think that's kind of what the market was trying to do in shaking out some of the newer entrants that may not really have the conviction, or maybe came in with some leverage and have been flushed out of the market. But we've created a lot more nervousness so that we can climb that wall of worry. And so as far as I'm concerned, if this is a correction, it's probably already over. I don't think there's that much downside in the price of gold from here. And the same thing with silver. I mean, silver didn't hold above 50, but it did take out 50, which is something it never did really in 1980 or 2011. We got almost to 55, and now we've had a pullback, but we're holding 48.50, which if you told people even a few months ago silver would be at 48.50, they wouldn't be, oh my God, it's pulling back. They'd be very happy that silver was at this price, and especially the gold miners. I mean, gold pulling back to 3,900 is great for all these gold mining companies. They're making a ton of money at $3,900 gold. They're making a lot of money at $2,900 gold, and that never really got factored into the price. I just think we're early in a broader bull market. I think that investors, mainstream Wall Street investors, both institutional and retail, are just finally noticing gold and deciding that they should make it a part of their portfolio. And this is after, gold is up 11, 12x this century. The Dow is down, close to 70% priced in gold since peaking in 1999. So gold has outperformed the markets, yet investors haven't even noticed that really until just recently. And I don't think that the fact that they've now decided that gold should be included in a portfolio, whereas before it had no place in a portfolio, I don't think that is going to change because, oh my God, now gold's 3,900 and not 4,300. I think you're going to start to see more accumulation of gold from investors who never bought any. And I think the central banks that have been the drivers for the past couple of years, I think they're actually going to pick up the pace of their gold buying. I think more central banks that weren't buying gold are now going to start buying as well. So I think there's a lot of new demand coming from gold, and I don't see a lot of new supply. I mean, there's some, but not nearly enough.
People who come to this event, people who are in gold, they're usually used to being the contrarian. So if they see the mainstream coming in, maybe they feel a little bit uncomfortable. So anything you'd say to those people?
Well, I think it's still contrarian in that now that the mainstream is dipping its toe in the water, it's still, a small percentage of mainstream investors. So I think we've got a ways to go before it's kind of a crowded trade. If you want to see, something that seems crowded or bubblicious, look at what happened in crypto. Look at the enthusiasm. This is, I think, the oldest gold conference. It's been going on for, 50 years, the Orleans conference. And there's more people here than last year, I think. But there's not 1,000 attendees. It's less. I forget, 600, 700. I was at the Bitcoin conference in Las Vegas over the summer. There were 35, 40,000 people who paid to attend. So we're nowhere near there. We don't have that kind of level of interest or enthusiasm. And when I was at that conference, nobody was worried about the Bitcoin price going down. I mean, everybody was 100% convinced it was going to 1 million or higher. But here, you get a lot of people at the gold conference. Well, they're nervous that we could get a pullback, and they're not like crazy enthusiastic that we're going to be at $10,000, $20,000 gold next year. So, I think it's still early. The people in Bitcoin they're convinced that they're early. And I was trying to point out, well, you have 35,000 people at a conference. It's not early. I've been going to investment conferences. That's the biggest one I've ever been to. And so that shows you that, a lot of people are already involved. You're not getting in on the ground floor when the conference is that big.
People keep calling this a pullback, but let's take a breath and actually look at where we are. Gold is sitting around $3,950 as we speak. That's not a collapse. That's barely a correction. We had a short-lived spike toward $4,400 that lasted maybe a week, and now we're consolidating just below $4,000. That's not a bear market. That's not panic. That's noise. We've gone up massively this year, and what we're seeing now is simply the market taking a breather before the next leg higher. But it's amazing how fast sentiment flips. You get a 10% dip after a historic run, and suddenly the same people who were screaming new all-time highs are now convinced it's all over. That's what markets do. They shake out the tourists, the leveraged traders, and the nervous newcomers who don't really understand what they own. This little correction is the market's way of cleaning house. It flushes out the weak hands and resets the sentiment. And as far as I'm concerned, that's bullish. Because bull markets climb a wall of worry. And right now, we've got plenty of worry. Think about it. Gold has been the best performing major asset of the 21st century. It's up 11 or 12 times since 2000. Meanwhile, the Dow Jones, when priced in gold, is down around 70% from its 1999 peak. Yet for most of that time, gold was treated like a fringe investment. Wall Street laughed at it. The financial media ignored it. Your financial advisor told you to buy index funds and trust the Fed. And now, finally, mainstream investors are waking up. They're realizing that gold has been quietly outperforming everything they own for over 2 decades. So this notion that gold is topping out because it's down a few $100 from an all-time high is ridiculous. Pullbacks are not the end of bull markets. They're the pause that refreshes them. If anything, I think the correction is already over. I don't see much downside from here. The fundamentals haven't changed. They've only strengthened. Inflation is sticky, deficits are exploding, interest costs are spiraling, and central banks are trapped. You can't fix that with rate cuts, and you can't paper over it forever. Let's talk about silver for a second. Everyone's saying, oh, silver failed to hold $50. Okay, but it broke through $50, something it's never done before. Not in 1980, not in 2011. It hit almost $55 this time. That's huge. And now it's holding $48.50. Let's be honest. If you told anyone 6 months ago that silver would be near $49, they wouldn't be complaining about a pullback. They'd be celebrating. What we're seeing isn't weakness, it's consolidation after a historic breakout. The same goes for gold miners. These guys are making money hand over fist at these prices. You could drop gold $1,000 an ounce and they'd still be profitable. Most of them were profitable at $2,000. Now at $3,900, their margins are exploding. But the market hasn't priced that in yet. The mining sector is still trading like gold's at $1,800. That disconnect will correct itself, and when it does, the miners will catch up fast. We're in the early innings of a much broader bull market, one that will eventually draw in mainstream investors, institutions, and central banks alike. The irony is that while the mainstream is just beginning to discover gold, the smart money, the contrarians, have been here for years. And that's why I tell people, don't let the newcomers scare you off. Because yes, we are seeing new participation from institutions that used to dismiss gold entirely. You've got pension funds, family offices, and even some hedge funds that used to mock gold bugs now quietly adding exposure. And that's fine. That's healthy. The total allocation to gold across global portfolios is still tiny, maybe 1% or 2%. Compare that to equities or bonds, 40%, 50%, or more. We're nowhere near the saturation point. Gold is still the contrarian play precisely because so few people actually own it.
Yeah, well, we just got a rate cut by the Fed, and that didn't seem to be the trigger. I think we're going to get another rate cut despite the fact that Powell kind of said it wasn't a lock. The markets kind of priced it in, and he kind of pushed back against that. But at the end of the day, I think there's going to be another cut because I think the economic data is going to continue to disappoint. Now, we're not getting as much data as normal because of the government shutdown, but it's possible that they end that government shutdown and we get a deluge of bad economic data that could be a catalyst for another move up, in the price of gold as people start to, factor that in. And the Fed at its last FOMC meeting announced that QT is officially ending in December. So I think another big catalyst will be the launch of the next round of quantitative easing, which I believe is coming. I thought it would have actually happened already, so I'm kind of surprised they were able to make it through the entire year without doing it. But I think 2026 will be the year that they, crank up the presses again, especially if they continue to see weakness in the longer end of the bond market. And then, of course, you do have, some court decisions, on the tariffs, on the firing of Lisa Cook. I think that could have implications for the dollar and for gold.
So do you think quantitative easing starts under Powell, or do we wait until his term is over? We've got this new Fed chair in that's probably going to be more Trump aligned. How are you seeing it?
Yeah, it's hard to say. I forget when does Powell leave? Midway through the year, May? I mean, I guess it's about 50-50 that, they can hold off on QE. It kind of depends on what happens. But I think if you start to see a big move down on the stock market or something that might scare the administration, there'll be a lot more pressure. And we'll see. I mean, today, we're getting a decent decline in stocks. I know Bitcoin, broke below 100,000 for the first time in about 4 months. And that could be a bit of a leading indicator that, people are starting to take risk off. And it may not just be crypto. It may be a broader-based risk-off trade, which also could see some money flowing back into gold as a safe haven investment. And I think as the air comes out of the Bitcoin bubble and people begin to question the digital gold narrative, which they should, because it's just a meme, to the extent that people wake up to the reality that Bitcoin isn't digital gold, well, then maybe they'll buy real gold instead. And so there could be a source of some extra gold buying from people who either get out of Bitcoin or instead of buying Bitcoin, decide to buy the real gold, right? Instead of some fake version of it.
When you look at the U.S. economy, how bad are you thinking it could get? What's your vision there?
Well, I mean, I think things are pretty bad. I mean, if you look at the most recent polls on Trump's approval, his approval on the economy is the lowest it's been of either of his presidencies. He only has a 30% approval rating. So that's not even like all the Republicans. And over 60% disapprove of his handling of the economy, right? Just the economy. That's supposed to be his strong suit, right? And, Trump is going around, touting how we have the strongest economy in the history of the country.
Let's zoom out for a moment. The real story here isn't about a few $100s of volatility in gold. It's about a complete shift in the global monetary order. For decades, the dollar reigned supreme. It was the unquestioned reserve currency of the world. But that dominance came with a hidden cost: debt. The U.S. exported inflation while importing real goods. We printed paper, the world accepted it, and we pretended it was sustainable. But as deficits ballooned and trust eroded, other nations began to quietly hedge their bets. Now we're seeing the results. Central banks are diversifying their reserves, not because they like gold, but because they don't like dollars. They understand that U.S. debt is mathematically unpayable, that political gridlock makes fiscal discipline impossible, and that debasement is now official policy. When inflation outpaces interest rates, holding treasuries becomes a guaranteed loss. Gold, on the other hand, doesn't yield, but it doesn't default either. That's why we're seeing record central bank gold buying, the fastest accumulation in half a century. Even Western institutions that once mocked gold as barbaric are beginning to change their tune. When the Bank of International Settlements reclassified gold as a Tier 1 reserve asset a few years ago, giving it equal standing with cash and sovereign bonds, that was a signal. It told the world's central banks, gold isn't dead, it's back. Meanwhile, retail investors in the West are still asleep. The average American portfolio is 60% equities, 35% bonds, and maybe 0.5% in gold. That's astonishing given the performance gap over the past 2 decades. If gold merely returns to its long-term average allocation of 5% across institutional portfolios, that alone would trigger a massive price repricing. And then there's silver, gold's little brother with the explosive personality. Silver has finally done what it hasn't done in half a century, broken above $50. Sure, it pulled back to $48, but that's not weakness. That's stability. The important part isn't the number, it's the psychology. Breaking that psychological barrier shatters decades of price suppression and skepticism. Once markets realize silver can, in fact, trade sustainably above $50, the ceiling becomes the floor. We're also seeing something we've never seen before. Governments acknowledging silver's strategic importance. The US has classified it as a critical mineral. China has restricted its exports. The largest refiners in the world are hoarding supply. This is no longer just a precious metal story, it's a geopolitical one. Silver is now the lifeblood of the modern economy. Every electric vehicle, every solar panel, every semiconductor, every data cable depends on it. And yet, global inventories are collapsing. The LBMA's vaults are being drained. COMEX-registered stocks are at multi-decade lows. That's not a healthy market. That's a supply crisis in slow motion. So while the talking heads on CNBC wring their hands about whether gold can hold $3,900, the real question is whether there's enough physical metal left to meet demand when this next wave of buying hits. And make no mistake, it will hit. Once the mainstream financial community fully accepts gold and silver as legitimate portfolio anchors, not fringe assets, the revaluation will be breathtaking. You know, it's funny. I've been attending gold conferences for decades. I remember in the early 2000s, we were lucky to fill a ballroom. You'd get a few hundred hardcore believers who everyone else thought were nuts. We were the weirdos warning about debt, deficits, and currency debasement while the world was drunk on tech stocks. Now, 20 years later, everything we warned about has happened, and yet the gold community still acts like it's the underdog. That's the irony. Even with gold near $4,000, we're still early. And if you want proof, look at sentiment. You go to a Bitcoin conference, 35,000 people, all euphoric, convinced the price is going to $1 million. Go to a gold conference, 700 people, cautiously optimistic but worried about a pullback. That's the difference between a mania and a mature bull market. We don't have euphoria in gold, we have anxiety. And that's exactly why it's going higher. Because here's the truth. Real bull markets end in complacency, not caution. They end when everyone believes the good times will last forever, when nobody hedges, when nobody doubts. We're nowhere near that. If anything, the average investor is still underexposed. The majority of financial advisors still don't recommend gold at all. They tell clients to hold diversified portfolios of overvalued stocks and bonds and hope for the best. But that strategy only works in a world where inflation is tame and central banks are competent. And we left that world years ago. So let me be clear, this isn't a speculative trade. This isn't about guessing the next $100 move. This is about recognizing the structural collapse of the fiat system and positioning yourself in the one asset that has outlasted every currency in history. Gold doesn't just preserve wealth, it reveals truth. When everything else fails, gold exposes the lies of monetary policy. It tells you what your money is really worth. And silver amplifies that message. Because silver isn't just money, it's the bridge between finance and industry. It's both a store of value and a cornerstone of modern technology. When that dual role collides with scarcity, the price will have no choice but to explode higher. I'll end on this thought. In every major financial transition, the early adopters are called crazy, until they're called geniuses. We saw it in 2000 when people laughed at those warning about housing bubbles. We saw it in 2008 when they ignored the debt crisis. We're seeing it now with those who warn about the end of the dollar's dominance. The difference this time is that the reset won't be cyclical, it'll be systemic. The dollar-based order that's been in place since 1944 is crumbling. The next system will be multipolar, commodity-linked, and less dependent on trust in any single government. Gold will be the neutral anchor in that system. So whether gold's $3,900 or $4,300 today doesn't matter. What matters is that we're transitioning from a world of paper promises to a world of tangible value. And that process is irreversible. In the years ahead, the question won't be, how high can gold go? The question will be, why didn't I buy more when it was cheap?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.